Ladies and gentlemen, please welcome consultant, banking expert, microfinance heretic himself, Mr. Hugh Sinclair, introducing us to practical solutions for every leadership team, leading in times of crisis. You can ask questions within Q&A during the presentation, and Mr. Sinclair will be available live for answers.
Hello, my name is Hugh Sinclair. I'm a consultant, microfinance expert, author and heretic. I've been working in the sector for about 20 years, and I've been consulting to Arabian pretty well since inception. And I have worked until 2019 at a bank in West Africa that was one of the early adopters of InstaFin. So I also know the product from the client perspective. The topic of today's talk is leading in times of crisis. I'm going to focus this a little bit further onto particularly digitalization and the impact that COVID has had most recently. As you can see from these two quotes that I've put up on the screen, somewhat begrudgingly, I have to admit that probably there is no alternative to digitalization. It seems that we've faced two choices: reap the benefits of it or be killed by it. And I'm now going to explain why I've come to this conclusion. So let's imagine an exercise in a primary school in the year 2030. What were our parents or grandparents using in the 20th century versus what people are using in 2030? I think actually this is a flawed analysis, because even the people in this summit, we don't actually know even what a telephone is going to look like even in 9 years from now. So this gives an idea of the state of flux that we're currently in. Now, this is focusing on music, transport, mapping, whatever. The big question for the people in this conference is simply, where is your bank going? We are in unprecedented times of change. The financial inclusion sector has been relatively slow to innovate over the last few years. When you look at what we're doing in 1970, 1980 to relatively recently, it was a few loans, some savings. The most innovative people were doing a few insurance products up until relatively recently. The changes which we're facing right now are simply unprecedented. The first question is, what is digitalization? Now, we could do an entire conference on this specific topic, but I would basically say there are three segments. First, the internal processes and analysis. By this, I basically mean getting data in the first place. Data is the raw ingredient for digitalization. The next stage of getting data is basically processing the loan, which is some sort of loan application forms and all the processes that go behind it prior to disbursement. And then any other activities that we can do in-house. So the reporting, the analysis, and the analysis of the portfolio might even extend to credit scoring and such items. The key point is that these are actions that we can do in-house without recourse to other players or other data sources. The key ingredient is the data in the first place. This is then augmented by connecting our data and our processes and our back office systems with other external sources. So this might include credit bureau data, communicating via SMS, business intelligence, big data services, whatever. This is basically other services which we clip onto our existing internal processes. Only then are we able to move to the final stage, which is digital channels. So whether this be agent models or e-wallets, whatever, these are often described as the end goal of digitization. And there's a temptation to try to run to the end goal without having set up the fundamentals, which I would suggest is an error. So these are basically the three steps which one goes through. So the next question is, why do we actually need to digitalize? Well, I would argue that there are four key reasons. First, costs. If we look at the case of Equity Bank in East Africa, their cost per loan as a result of digitization fell by 80%. 97% of all their transactions are done outside of their branch network, and 70% of all transactions are initiated by the client, not by a loan officer or by the bank itself. Now, imagine if your competitors suddenly have an 80% reduction in their costs. It fundamentally changes the entire sector. So the next reason to digitalize is the competition. Whether we like it or not, whatever our own personal views are of digitalization, the fact of the matter is our competitors are doing it and new entrants are coming into the market, including the pure fintechs. So even if we decide to go down a non-digital channel, digital competitors are going to come in and they're simply going to steal our clients. A third reason is the expansion of services. It's the microfinance sector and the SME sector has been relatively slow to innovate in the last few decades because it's difficult to innovate, to launch new products. The advantage of having a digital fundamental basis in your bank is that adding new products, whether that be savings or insurance products or remittances, becomes easier if you have this core base. And I think a final reason for justifying why we need to digitalize is simply for outreach. The old model of lending relied to a great extent on having a core of clients that would generate a profit for the bank, and that profit could be used to partially subsidize the more risky, the more remote, the poorer clients who generally have a higher cost per dollar loaned. That model is being challenged now by the digitalization. So in order for us to be able to reach these more remote and isolated clients and the riskier clients, we need to fundamentally reduce our operating costs. And the only way to do that is to digitize. So COVID has basically come along and unfortunately accelerated this whole process. And I think the reasons why this has happened is fairly straightforward. First of all, smartphone usage has increased dramatically. Microsave did a survey in India, East Africa, and Asia, examining the use of which apps are downloaded as a result of COVID. The first two categories of apps, the main increases in app usage was as expected. Government provided COVID-related apps, track and trace, whatever, often obligatory. Entertainment apps, when you lock 1 billion people up in their houses, it's no surprise that Netflix usage goes up a bit. But after entertainment and COVID-specific apps, the next biggest category was digital payments. In the Microsave survey, 61% of all respondents suggested that cash receipts in their businesses had gone down, and 57% said that digital payments have gone up. This is in 1 year. It's actually quite astonishing how quickly this shift has taken place. And the other factor is that social media usage has gone up. Again, in the Microsave survey, 1/3 of all respondents said that as a result of COVID, they had started using social media as a way to communicate with their clients. Many were already using social media, and clients were already using social media prior to COVID. And when they're locked up and it becomes their main source of communications, and all the more important to get news and information about what's happening in their regions, social media usage has just taken off. But I think really we can summarize it more simply. People were just forced, they had the gun put to their head. If you can't go to the shops, if the only way you can arrange delivery is via digital repayment, if the only way that you're allowed out of your house is by downloading, filling out some things on an app, people, even those who were resisting this, have increasingly been obliged to adopt this new technology. And as they start to reap the benefits and the convenience of being able to buy things online, being able to communicate with people freely, it's a very difficult habit to break. So I think whether we like it or not, smartphone usage has exploded and social media has exploded even more than previously. And we need to take this into account in our fundamental model. And to not do so is simply burying one's head in the sand, and that is rarely a good idea. So what do we do? I would suggest that step one is to stop the bleeding. Regulatory compliance. There's nothing worse than embarking on a new project with a grumpy regulator. Make sure that you're on good terms with the regulator. Secondly, make sure you are financially solvent. The micro and SME social impact investment funds are also suffering right now. And what we're witnessing is a flight to quality. Those institutions, those financial institutions that are quite secure, are not having any problems raising capital because the funds need to invest in someone and they don't have that many people that they feel confident to invest in. But at the other end of the spectrum, the funds used to have a certain appetite for taking risk. That appetite has all but dried up now. They are paranoid, and anyone who is slightly below their risk threshold is unable to obtain financing. So we're seeing a polarization of the sector. So step two, I would suggest, is make sure that your sources of finance are secure. Thirdly, all those reports and metrics that you measured pre-COVID are now no longer valid. PAR doesn't really make much sense. Restructured and refinanced portfolio doesn't really make much sense in a COVID environment. And it will take some years until we've got through this whole COVID period and we can go back to those metrics. So for clients who have, for example, in the case of Instafin, the dynamic reporting tool, this is an almost infinitely flexible tool for designing your reports for specific circumstances. It's worth going through them and making sure that you've got all the reports designed for a COVID world. Now, this is relatively easily done inside Instafin. In other core banking products, it might be more difficult. But the quality of your decision making is based on the quality of A, your raw data, and B, your ability to analyze it. So it's important to make sure that you have the reports up to date. And then really the only thing is proactive portfolio management. Normally, one should pursue unrecoverable portfolio. In this current circumstances, I would say that there's insufficient management time and bandwidth to spend too much effort trying to pursue unrecoverable portfolio. Often this was justified on the basis of maintaining the reputation of the institution. Now I would suggest that in this window, that's not so urgent. Focus on what is recoverable, what is partially recoverable. With the partially recoverable portfolio, i.e. portfolio which is worth pursuing, make sure that you've reviewed your refinancing restructuring terms and make sure that branch managers or whomever it is have the authority to negotiate on behalf of the bank with the clients to obtain whatever is feasible. But again, try to get through this period as quickly as possible so that you can start focusing on growing the portfolio and working on what is essentially a healthy portfolio as opposed to being held back by a legacy portfolio. Second stage is creating your digitalization strategy. I suggest the first pass at this is to just take a deep breath and have a look at the current situation. What data are you actually capturing? What is the quality of that data? How complete really is it? Remember the old IT saying, garbage in, garbage out. It doesn't matter if you do the most perfect digitalization strategy with the best core banking system and the most amazing technology. If you don't have good data coming in at the beginning, it's garbage out at the end. Look at the features in your core banking system that you're actually using. I spoke to the Iranian staff and asked them, what do they estimate is the percentage of features that their typical client is using? And they responded that it was approximately 40%. You're paying for 100% of the features and you're using only 40% of them. Seriously consider that the other 60% might be useful. They're not there just to keep the Iranian developers busy. They're there for a reason. Come up with a roadmap and make sure you've got the right staff to execute the roadmap. There may be a chicken and egg situation here. Maybe you need to hire some staff in order to form the roadmap. Maybe part of the roadmap is hiring new staff. Either way, that you need to cover those two bases and have a clear plan of how you're going to digitalize. In all these stages, you can go to Radian and ask for their advice. They know all about this. They can see your database. They understand which features are available, which ones you're using, and they're familiar with the process of digitalization. The second piece of advice is to always remain client-centric. We talk about this. It's nice to say, oh, my business rotates around my client. In reality, it's not always the case. So there are two tricks to this. First of all, data capture and loan application. It's worth focusing on these, but from the client perspective. Imagine you are the client having to fill out the forms, applying for the loan, going to the branch, coming back from the branch, filling out another form, providing ID, all the different stages. Imagine you're the client. Every time that you feel a sense of frustration or a sense that there must be a quicker way to do this, that's the clue that your digitalization process needs to consider this. There's all sorts of ways that you can automate and optimize these processes if you put yourself in the client's shoes. The first stage is the data capture and the loan application, but possibly once you've automated those aspects, it's good to look at the time to disperse. Banks can disperse from 5 minutes to 5 days, who knows? Look at all the different obstacles that cause you a delay, whether it's a matter of minutes or a matter of days. What is causing you a delay in dispersing a loan? That is a clue of where you need to improve your processes and reassess your data and the flow of data through your back office system. The key thing here is don't try to run before you can walk. It's tempting to try and get to the end of the digitalization map without focusing on the really basic things. How do I know the date of birth and the ID number and the number of children and the address where my clients live? It sounds boring and old school, but until you have that fundamental basis, you won't be able to reap the true benefits of digitalization. So the third, to take on the pure fintechs. This is possibly unfair on the fintechs. There are new entrants which might not be pure fintechs, but anyway, how to take on the competition in this new realm in a post-COVID world? Well, I think the first thing to remember is that banking is a relationship business. There may be a certain group of clients, middle class clients with decent collateral that you can securely lend to without much risk and without much due diligence. That is not traditionally the target market of your clients. Those that are lending in micro and SME segments, this is fundamentally a risk-based, relationship-based type of lending. You need to understand the client's business. You need to know the client, look them in the eye, have that gut feel, form the relationship. And the relationship is not just the bank trying to assess the risk of the client, but also the client wants to have a relationship with the bank. The client wants to be asked these questions and challenged. And when a client is given the loan, it's almost a sign of approval that they've passed through these various stages. The loan officers, your loan officers should be in the field. A good bank should have their loan officers physically in the field with clients at least 75% of the time. A very good bank would be above 90. Look at all the time when your loan officers are not in the field. This is a sign of something going wrong, something that could be optimized, something which could be done better, something which should be digitalized. So it's actually useful to literally follow some loan officers and see why is it, what are they doing when they are not with a client. Now remember, when you have something like the InstaFin loan officer application, the loan officers can, on their cell phones or on their tablets, can be capturing the data live with the client, off or online, and there really should be very little reason for loan officers to come back to the branch more than once a day. And this will solve so many problems. The loan officer app has been designed to seamlessly guide the bank and the loan officers through the digitalization process. It's almost digitalization in a box. It's worth seriously considering using that app. Bear in mind that new entrants, whether these are pure fintechs or new emerging digital banks, they're not stupid. They've done their research and they've looked at your market, and they tend to be quite focused in the products that they launch. So they will have assessed the sector and worked out where your vulnerabilities are, and that is where they will attack. So there's two things to do here. Look at where the new entrants are entering, in which segments, which clients, which products, but also have a look at your own product range and ask yourself honestly, do we really have the range of products that our clients want? You can't be a jack of all trades and offer everything. So there needs to be a kind of introspective analysis of what really do we need to do. Let's focus on what we really want to do, acknowledging that that can't be everything. But the fintechs will slowly start picking off your clients. So after the initial investment, you'll see, ideally, operating expenses will start to go down. As I mentioned, the example of Equity Bank. This will increase your productivity, your efficiency, all that. Your knowledge of your clients should start to increase. PAR will ideally decrease as a result of this extra knowledge that you have and streamlined processes. And ideally, your market share will increase. But there is a danger here to always be striving to become the cheapest. This is not necessarily what the clients want. There are niches. For example, the middle class collateralized consumer lending category, which is entirely based on price. But the typical micro and SME client isn't as price sensitive as people believe. They value the relationship and they're willing to pay for it. So the idea is, don't strive to necessarily be the cheapest, but strive to be the best for what your client wants. So in conclusion, I admit somewhat begrudgingly, I now accept that digitalization, it is just simply inevitable. There's nothing we can do about it. I think failure to digitalize will force financial institutions into ever decreasingly important markets and marginalized markets and remote and isolated segments. And I think even institutions that fail to digitalize and service ever decreasing niche clients, I think eventually it is just a matter of time before digitalized, more efficient financial competitors will come in and take those clients. I just don't see that there's really any alternative to this. And moving ever further into the fringes is not an option. Do not underestimate the value of your core asset. Your core asset is not your portfolio, it is your relationships with the clients. This is what the new entrants really want. They want your relationships with your clients. Nurture these, but always be aware that they can be lost in a second. And once a client has left your institution and gone to another one, and especially if it's an institution that offers all the fruits of digitalization, it's very difficult to win that client back. I think also more fundamentally, you financial institutions, you know your clients very well, their market, the reality of their day-to-day lives. Yeah. And this is information that Aradian could never obtain. But you also have to accept that Aradian knows core banking better than anyone, any financial institution. How many cases are there in history of financial institutions embarking on developing their own core banking systems, and 5 years later and a few $1 million down the drain, they acknowledge it doesn't work? COVID has put us all under stress. This is not a time to be reinventing the wheel. You, the financial institutions, have got great skills. You have the relationship with the clients. Use that, but rely on your partners. Allow Aradian to do your core banking, and you focus on what is important, being out in the field, face to face with the clients. So my final practical advice, and I'm sorry to end on a bit of a negative note, but I think had we done this presentation 2 years ago before COVID, I would have said that digitalization is a priority. I think now it's more than a priority, it's becoming an emergency. So I think fundamentally time is running out, and it is time to embark on this project as soon as possible. Thank you very much, and I'll take questions.
Hugh, thank you very much for that presentation.
Good morning.
Lots of interesting things, and I've been making a lot of notes here. But maybe if I can just touch on what you were ending there, and we've heard a lot about digitization. Where does one start in digitization? And I reflect on, a couple of weeks back you were talking about this, and you kind of said, you gave me an indication it starts with the disbursement of the loan. Could you give me some more color? What was the intention when you said start off there? Because I think there's lots of topics that you've said here, and sometimes it can be overwhelming. Can you give us more color where to start? It's clear that we have to do digitization.
I think the key place to start is with the data. So look at what data you've got. Now, I've done endless consulting assignments with institutions, and including with clients that have used Instafin. And they've invested so much in technology. They've got a good team. They've trained all the staff up. And when you actually look at what data they're capturing in the field, it's low quality, unverified, often missing. Often a lot of the fields which could be obligatory fields of data to capture are deactivated and turned to voluntary. If you don't have the data coming in, you get garbage out. So that has to be the first place to start. The more data you get on your clients, the better. And it is incredible. If you look at the predictive power of simple pieces of data, for example, date of birth, marital status, number of clients, there are some really low-hanging fruit data which is easy to capture and actually is an indicator of subsequent loan repayment, much better than you might expect. This data can then be fed into credit scoring, all the kind of big data analytics tools which are now coming out. If you don't have the data, it's useless. And so the question then becomes, how do you get this data? And is this data being captured in a practical way which is convenient for the loan officers and for the clients? If it's awkward to capture, your loan officers will work around it, or they'll fake it, or they'll leave it blank if they don't have to fill it out. And if it's inconvenient for the clients, eventually you'll just annoy the clients and drive them away to other institutions that aren't so demanding. So that's why I also say be client-centric. And the best way to be client-centric is put yourself in the client's shoes and just imagine you've walked into the bank or you've had your first contact with the bank and you're applying for a loan. What data do they ask you for? How do you obtain the data? Do they have to fill out endless pieces of paper coming around to your house, then go back to the office and type it all in and then come back again with the next batch of data? And is it a convenient and seamless process? And the way to do that is to think about the initial contact and the loan process from the perspective of the client. In a sense, if you have an inefficient process and you manage, but the client doesn't see that, I mean, it's a pity, it's a waste of time and money. But from the client's perspective, they don't care whether you're doing things painlessly and efficiently behind the scenes or if it's super uber efficient. But what is the client experience? And that usually is the indicator that tells you where you've got problems.
Thank you. And a question from our audience. What metrics would you recommend focusing on if PAR is no longer meaningful in times of COVID? How would you tailor the reporting?
Yeah, I mean, this is very dependent on the specific circumstances, the regulations in place in your particular country. So I'm probably speaking it's a little bit biased towards the situation in Latin America, but I noted down there's probably 4 key areas. First of all, accruals accounting. For banks which are using accruals accounting, that is no longer really that valid right now. So you need to move to, temporarily at least, move to completely cash-based accounting. Cash is king right now. So the fact that you're accruing interest on loans, but you're not actually being paid it, under normal circumstances, that's somewhat akin to income. Right now, no, it's not. So shift to completely cash-based accounting. It's looking at what are your actual versus expected repayments, and the expected repayments themselves were previously determined by the loan repayment schedule. Now that repayment schedule itself has often been changed, and because of government initiated loan repayment holidays, for example. I mean, in countries such as Peru and Ecuador, the government's immediately just said, right, there's a 6-month repayment history. Right, so you need to adjust your repayment calendars by 6 months. You don't do that in practice, but in the reporting, you can alter your reports to take into account, well, my expected repayments aren't as the reports are generating because they're based on pre-COVID. So you modify your expected repayment and then compare your actual repayments to that. The other one is looking at voluntary repayments. In Latin America, we've seen, as a rule of thumb, there's approximately a 20% niche of clients that have been completely unaffected by COVID. In fact, quite a lot of them have seen their businesses increase. So, for example, I mean, people involved in food delivery or whatever. There's in different countries, there's certain areas which have actually benefited from COVID. So some of these people are actually prepaying their loans. We've actually seen in some countries, loans being paid ahead of schedule, actually prepaid versus what would have happened under COVID situations. So looking at voluntary, the unexpected savings, normally you don't really care about those. Right now in COVID, you do. And I think the fourth one is probably looking at changes in savings habits. So beefing up the reporting on savings. Again, often savings and reports on savings are somewhat passive. Oh, we've got some savings, or savings come in, savings go out. They're not actively managed. The problem is that I think savings serve two key functions. They're one, an indication, they're a cushion to the bank. The greater the savings of a client, the client can always dip into those savings to repay the loans. So as savings go down, or ideally if savings go up, this actually gives assurance to the bank. But the other thing is that withdrawal of savings is a sign of stress, and this can give you an early indication of which client groups are struggling in particular as a result of COVID. So that's why I look at savings in particular.
Something I want to reflect on. You mentioned relationships, and we heard a lot about that in the conference. And yesterday we were listening to Charles talk about high tech, high touch, and they see that financial institutions having this high touch and knowing the community seems to be very beneficial to them. We have a question again from our audience, and I kind of wanted to merge those two things. The question in the audience is, how can financial institutions build relationships with their clients digitally? Do you think they can do so in a sustainable and effective way? In times of COVID, being in the field, having face-to-face meetings with clients has not been feasible, while at the same time clients have started to realize the benefits of digital payments, not going to branches, etc. What are your thoughts around that? How's the market shifting, and do you think that it's a short-lived approach having high tech, high touch, or do you see that it's an evolutionary process?
I think it's this idea of the race to the bottom, that the only reason why someone chooses one particular institution over another is based on price. This is a complete myth. I think, obviously, I'm not in favour, and I've been quite vocal about exploitative interest rates, but I think at the end of the day, we can over-exaggerate how price-sensitive clients are. The difference of a loan costing 2% per month or 1.9% a month makes not the slightest bit of difference, and increasing, those sorts of margins don't alter the repayment ability. What the clients want is a quality relationship. They want service. And this is fundamentally a relationship, regardless of the way that you communicate and the type of contact that you have. This is ultimately building a relationship between the bank and the client, and clients appreciate that and are willing to pay for it. So the idea of having these, never being able to get through on a phone call, leaving messages on these chat bot things that never get back to you, poor customer service is absolutely, it just destroys relationships. And how often have we been in these situations ourselves? We've become extremely frustrated. But I think the key thing is to get the loan officers use digitalization as a way to improve efficiency, cut costs, be more nimble, and get the loan officers out into the field in front of the clients as much as possible. A really interesting calculation to do that I urge all banks to do is, how much time does my typical loan officer spend with the client during one particular loan cycle? And it's really disturbing. Often the amount of time after the loan has been dispersed is measured in minutes. Try to increase that. Reap the advantages of efficiency and use it to spend more time with the clients and nurture that relationship.
Thank you. Thank you very much. Very, very insightful, and lovely to have you with us for the conference, for the summit. Hugh, thank you very much. And just to our audience, we invite everyone, please don't forget to do the polling. We have 3 great prizes for the polls, which will be drawn out at the end of the day. Thank you very much. Hugh, once again, thank you. And we can move on to the next session under the agenda list.
Thanks.
Cheers.